Well, one more thing I need to ask you about is about government's Treasury Bills Sale, which has been undersubscribed for the fourth week running by at least 16%, we are told. What's happening, do you think?
I think the now government is actually competing with a lot of issuers on the market. To be frank, if you look at our fixed income market, I think it's evolving, and for the past half decade, I mean, it's grown quite significantly. So even though government is still remains the largest issuer on the market, we have seen a number of quasi-government institutions like the Get Fund, which is the Dachin Trust, and also you've seen ESLA and other corporate bonds that are also from time to time come on the market. So investors have choice, or foreign investors or fund managers for that matter have choice. So sometimes when liquidity actually dries up a little bit in the banks, I mean, they actually look for higher yields on the secondary market. So if the treasury rates or the primary issuances by the government is not carrying very attractive yields, they may direct their resources elsewhere. And that could be a possible explanation why we have seen that level of under subscription for those issuances on the treasury market.
For now, it looks like government will continue to borrow from the domestic market. How does that affect short-term securities?
I mean, if government is borrowing from the domestic market, I think it's a good thing to do because for the past few years we have seen some the market as a whole actually building up capacity, and we've seen a lot of inflows going into the pension funds. So that is good for government to use that strategy to finance its budget deficits. Because of course, if you borrow from the domestic market, especially when you have a lot of pension funds or domestic investors participating or lending money to government in that process, that helps to reduce the government FX exposure. Because if you have foreigners actually coming onto the market buying domestic bonds, and in the event that these foreigners are actually selling and repatriating their revenues from those bonds away outside, it put a lot of pressure on the city. So it's a good thing, but the thing is that for the past few years, we have seen the influence of foreign investors actually waning on our market. I mean, for just about 3-4 years ago, we're talking about something in excess of 70%, foreign holdings in terms of the fixed income holdings of treasury fixed income, or treasury bonds. As we speak now, that has dropped quite significantly to around 30% or so. So that tells you that domestic investors are actually taking up more bonds, which is actually a good thing or a good news for the government, because it will help to reduce its FX demands that comes with increased foreign investment on the bond market.
My last question to you, we are in the last quarter of this year. What should we be looking out for to end the year on a very good note?
Well, I think the post-COVID recovery is still ongoing. Government has an ambitious plan to spend about $100 billion to actually revitalize the economy. We have seen that also reflected in the confidence in the stock market. We think that the stock market is a very viable option at this moment because the companies that are listed on the market, which were hitherto or last year affected by COVID, these companies are recovering in terms of their operations. And we think that that is going to have some positive impacts on the equity market as a whole. So the equity market, I think, will offer investors some good opportunities. We also think that looking ahead, the fixed income market is also attractive, and I think investors could also be looking at that. especially in the mid to higher end of the bond market. I mean, if you look at it from, let's say, 3-year bond, 5-year to 10-year bond, I think the rates are a bit attractive. So for us, we think that the market, if you look at it, the spectrum from equity to bond are looking very good. If you look at inflation, we think that inflation, we've seen some uptick in inflation recently, but there's still risks though, because harvest hasn't been, or there are reports that food harvest is not going to be great this year because of unfavorable rainfall pattern. So that is also a risk in terms of inflation. But largely, we expect inflation to stay within around upper band of the central bank target, which is around 10%. With regards to the cedi, I've talked about that already. We expect the cedi to remain also fairly stable for the rest of the year, supported by a strong reserve position of Bank of Ghana.
All right. Thank you for your thoughts this afternoon on the marketplace. I appreciate your time. That was Head of Data Bank Research, Alex Boahin.